Unlimited CEO Bob Elliott and Wilmington Trust CIO Tony Roth. Happy Friday, guys. Bob, if I look at this week and today, the 10-year yield has to be a big part of the story. Now stands at around, 4.24%. It surged above 4.1 to start the week. The surge today maps with the air coming out of stock gains. How do you see its impact?
Well, I think it continues to show the dynamics of over-easy monetary policy signaled by the Federal Reserve. That long-end rise, we're up 50 basis points basically from the time that the Fed introduced their 50 basis point cut. And as a result, that monetary policy looked too easy given the strength of underlying economic conditions. And even today, we get more stats, durable goods better than people expected, consumer confidence a bit better than people expected. All of that combined with strong labor market data, all combines for the fact that maybe the Fed was a little too aggressive in easing right away, and that we need to back out a lot of that easing that was priced in that aggressive easing. And that's basically what we're seeing. Bond yields rise, and it's flowing through to the rest of the market.
Okay, so, Tony, you say the yield surge shouldn't be a problem if inflation stays under control. So how much pressure does that put on the last jobs report before the election out, I think, a week from today?
Yeah, hey, John, and good afternoon. Happy Friday. I think it puts a lot of pressure on the jobs report. I think that when we think about why the market struggled so much this week with the higher rate environment, we did have the record of the NASDAQ today, but it was barely. And so what's happening in the market right now is the market is really looking for a catalyst to the upside. The election may give us that. And at the same time, there's a lot of concern and apprehension that the Fed rate cut cycle is going to stall. And so if we get a big labor market report next week, let's say above 250,000 new private payrolls, that could really provide the impetus for the Fed to not move in November. And I think that would really undercut the premise, the short-term premise at least, for the big rally that we have seen in equities.
Bob, let's say that happens. What do you do?
Well, I think right now, if you look at the next 10 days, it's going to be a pretty wild next 10 days. We've got Mag 7 earnings, we've got a QRA, we got the election, and we've got a Fed meeting. And I think in the time being, there's a lot that we'll get a little more clarity on in terms of the direction, both of the economy and on policy. So right now, probably time to ease back a little bit, take a little bit of risk off the table. I think in part that's what we're seeing this week across stocks as people are positioning with a little less risk ahead of all this information. Really, for me, I'm focused on whether or not the Fed in 10 days is changing their reaction function. They looked about 6 weeks ago that they were comfortable easing into a relatively strong economy. The question is going to be whether those, pretty good job reports and some inflation pressures that are coming back into gear are the sorts of things that are going to have them pause their easing cycle, or is it carry on forward? And if it is, all the momentum that we've seen from the over-easy monetary policy trade of the last 6 weeks will push forward.
But I guess maybe if not, then it won't, Tony. What positions would you have in place in case we get a very strong jobs report?
Well, first of all, I want to make sure that we remember that we've got a PCE report coming up, too, which is going to have a big impact on how the Fed reacts in early November. If, in fact, we get stronger inflation in the PCE report and we get a stronger jobs report, then I think that we want to be a little bit more defensive and we want to be a little bit more focused on quality across the board. But most investors are not going to be that tactical, if you will, at least not the ones that we work with in their portfolios. And I think that the other catalyst that is obviously on the table right now is this election coming up. And what I would just say real quickly, John, about the election is that unless we have, they're not possible outcomes when we think about the two houses of Congress and the White House, and unless we get a blue sweep, because the market's clearly not pricing in higher taxes right now, in almost any of those other scenarios, we see a catalyst to the upside, whether it's a continuation of the status quo with a resolution of the election in the case of Harris winning with divided government, or whether we have Trump with an improved regulatory environment and an improved tax environment. We end up with a lot of reason to be hopeful for stronger economic growth. Even if it does mean slightly higher rates, nonetheless, it means better earnings and a continued economic expansion.